Hello friends, welcome. Friends, today we are going to talk about a very important subject. Now this video got triggered because of a dashboard which I had shared couple of captures the value of rupee, the depreciation of rupee since FY20 Q3 till date, and you can see in this dashboard that the rupee has depreciated by 16.8%. Similarly, there are other currencies which has also depreciated, but there was a question which was asked that what is the reason for depreciation of rupee? And since there are all various other currencies, you look at this chart, you will find that there are many other currencies which have not depreciated as high as what rupee has depreciated. For example, Indonesian currency has depreciated 11%. Philippines currency has depreciated by 7.9%. Euro has depreciated by only 1.3% versus US dollar. But rupee has depreciated much more compared to other currencies. Now, that is why I am doing this video, to explain the concept and backed by data. And therefore, this video is going to be pretty important. Right? So, the first contradiction, let me point out in this chart, is that rupee depreciation is happening irrespective of the fact that the dollar situation, the Forex exchange situation in our country has improved significantly. If you look at this chart, you will find that our foreign exchange situation has improved from $595.1 billion to $646.6 billion, $50 billion of increase of foreign exchange reserve, which clearly tells us that there has been a clear demand for more rupee. Because what is happening is that when foreign exchange is getting stored in RBI will exchange those foreign exchange with rupee, which will be used internally for various purposes from the point of view of investment, etc. So what will happen is, because the higher foreign exchange, naturally the rupee should appreciate given this demand and supply equation. But we are not seeing this. Rupee is depreciating, and that is the purpose of this presentation. So I am going to take you through hardcore data. So be with me till the end. You will understand this and you will not repent watching this video. Let me guarantee you in the beginning itself, because a lot of hard work has put by me in this video to aggregate this data. So let's go to the first chart, the chart number 1, which points to the fact that why there has been a increase of foreign exchange, what has contributed to increase of foreign exchange. So I'm going to take you through various items and explain to you one by one why foreign exchange in our country has increased, and why even though the foreign exchange of our country has increased, why there has been a rupee depreciating, and we're seeing a lot of pressure as regards its value against US dollar is concerned. Now, the first important thing in this chart is that imports have fallen. Because imports have fallen, it has resulted in less pressure on foreign exchange, because as an importer, if I have to buy something from outside, I have to pay that for that commodity using foreign exchange. So that foreign exchange is going to flow out of the RBI's balance sheet, right? So it should decrease. Therefore, since imports have decreased, the foreign exchange pressure on foreign exchange to be used to pay off for those imports have also decreased. But there is an important point to understand here. This decrease of import has not happened organically. Organically means that you really wanted to consume or less, or have done something significantly better to conserve those imports. It has happened because the price of crude oil has stabilized. Now, if you look at this chart, you will notice this, that these two line items, coal and coke and petroleum, has contributed towards a decrease of imports by $40.6 billion. Now, you look at these numbers, you can do the calculation yourself. However, there have been a very, very important focus in India to conserve imports of electronic goods by driving a PLI scheme, which we all know. Similarly, there has been an earnest effort from the government side to conserve on gold imports, by doing a lot of schemes like sovereign gold bond schemes. In spite of the fact that there have been a focus in enhancing local manufacturing of electronic goods as well as preventing imports of gold, both these line items have increased by. So electronic goods have increased by $9.4 billion, gold imports have increased by $10.5 billion compared to the earlier financial year. So, because the petroleum imports have decreased, so there has been a decrease of overall imports by $38.6 billion. So that you can very easily do by subtracting this from this, because what has happened is this is the FY23 number and this is FY24 number. So you can just subtract this, you will find that this is $38.6 billion. So this is positive. So that's why I have marked it with green star. However, there is a bad news. The bad news is that exports have also fallen. Now, why exports have fallen? Because everybody knows that we in India import crude petroleum products, refine them and send back to the world economies for their consumption. Now, since the import on crude have fallen, therefore exports have also fallen. Exports have fallen by $13.3 billion as far as petroleum product is concerned. And there is one more line item which is gems and jewelry, where also the exports have fallen. So together there has been a fall of around $14 billion compared to the earlier financial year. So there has been a decrease of trade deficit to the tune of around $24.6 billion on account of both these line items. So summarizing this, you can look at this chart, you will summarize this, that India's overall CAD, current account deficit, has fallen by $43.5 billion. Right? Now, why $43.5 billion? The reason it has fallen by $43.5 billion is that though the merchandise, which is the trade deficit which I showed you, has fallen by $24.6 billion, the services actually has contributed to a trade surplus to around $18.78 billion. So if you add these two, this number comes out to be around $43.5 billion. So there has been a conservation of foreign exchange to the tune of $43.5 billion. So this should show up as in the RBI's balance sheet as an increase of foreign exchange. That is what normally, because if you have saved so much amount of foreign exchange compared to what you did last year, this should definitely show us as an accumulation of foreign exchange, right? Now let's go to the next chart. This is also very important, because this is the point number 2. The point number 2 here is that foreign investments in India has shown somewhat different trend compared to what we saw in the earlier financial year. Now, in foreign investment, there are two types of foreign investment. One is foreign direct investment, another is portfolio investment. And both this together adds up to the total investment here, right? So if you look at the foreign direct investment, it is not a very good news. Foreign direct investment has fallen by $12.6 billion compared to what we saw in FY23. However, the portfolio investment, which is the more volatile form of investment, because when you make foreign direct investment, you're supposed to make investment in brick and mortar, and it is more sticky. It stays in the country. It is not very volatile. Whereas FPI means you are making investment in the stock market. When you are making investment in the stock market, it is more volatile. Because it is more volatile, it has got more impact on the valuation of rupee, right? So, if you look at the total investment will add up to both the FPI as well as the FDI, so which is $46.7 billion compared to FY23, which is $22.8 billion. So there has been an increase of $23.9 billion of foreign investment in India, not direct investment, total FPI and FDI in total. So this is I have basically categorized this as red because of portfolio investment increasing, which has resulted in a more volatile form of investment, right? Which might impact the valuation of rupee because of the intense transactions which will take place on a daily basis. Now coming to another important point, which is about external debt. Now, if you look at external debt, why external debt is bad? The reason external debt is bad is because it causes outflow of foreign exchange because of the debt services which you have to do in form of interest payments, right? Or on other kinds of tangible, intangible things which you have to do, because anybody who is making investment in India, when you take a debt, would definitely like to have returns, and those returns have to be paid in foreign exchange. So here you will see that India's external debt has increased from, because this data is only for 3 quarters, so therefore I have compared 3 quarters of FY23 versus FY24, and you will find that in the last 3 quarters of FY22 24, which is the third quarter of FY24, it is $648 billion of external debt, compared to the third quarter of FY23 it was $611 billion. So there has been an increase of $37.1 billion of external debt. So our external debt, if you look at this chart, you will find that it has been steadily rising, which is a bad news. Therefore I marked it red, and this has resulted in more outflow as regards our debt service obligations are. Right. Now let's go to the other point, which is our balance of payment situation. Now, balance of payment is a very, very important document. It has to be looked at with a lot of care and seriousness, because what happens is that this is the document which the line item, which is the last line item, which I'm going to show you here, which is here. This is the line overall balance of payment. This is the line item which actually adds up to our foreign exchange reserve. So therefore you have to look at this this document very carefully. So let's go on the first chart, because there are 3 different sections of this document. The first chart is the current account deficit. Now, as I told you that the current account deficit of India has actually driven down by $34.6 billion. Now here, if you see here, this document is not for 4 quarters. This is only for 3 quarters, because the 4th quarter information of FY24 I don't have. So what I've done is that I've compared only 3 quarters. I've not compared 4 quarters, but this is going to give us a very good indication where we are standing. So the current account deficit situation has improved, which we have already seen here, which is a good thing, because it will add up to the last line item, which is the overall balance of payment. The second important point, if you look at here, which is called capital account. What is capital account? What is the difference between capital account and current account? Current account is on account of trade, goods and services, which I have already explained. Capital account is on account of investment, which can be foreign direct investment and portfolio investment. And then it contains all kinds of items in India, by India, and all kinds of things. But let's not get into all the line items, which you can pause and see, because this is a completely standalone and fully exclusive, or I can say that it's a complete chart which you can investigate by pausing this video. But let's talk about the overall numbers. The overall numbers, as far as capital account is concerned, in the last 3 quarters, it has been around $64.7 billion if you add up the last 3 quarters of FY24, and FY23 it is $52.4 billion. So there has been an increase of $12.3 billion. So our capital account has improved, right? And let's go to the last chart. Last chart means of this particular section, which is the capital account, page 2. Here we have loans, external assistance, and other items. So if you look at the last line item, the overall balance of payment, 3 quarters of FY24 is $32.9 billion. So this will add up to our foreign exchange reserve, $32.9 billion. And in the last year, it was minus $14.7 billion. So we have enhanced our foreign exchange reserve by $46.6 billion, clearly visible from this chart. So India's overall balance of situation has improved. So everything is showing positive. So that's why this has been marked as a green star. Now we come to the foreign exchange reserve. Now foreign exchange reserve is definitely a reflection of the BOP situation, which I have explained to you in the earlier chart. Now if you see here, what did I show you? Our foreign exchange reserve should have increased by $46.6 billion. So though the 4th quarter information is missing, but it will roughly be approximately equal, right? It won't change significantly. But as regard the RBI foreign exchange data is concerned, I have the data till 4th quarter FY24. So you will find that the total foreign exchange reserve of RBI has increased by $50 billion right, compared to the last financial year, which is end of FY23, right? So there are two components here, which is important. One is the foreign currency asset, another is gold. Now, if you look at foreign currency asset, the increase has been $42.6 billion. Now, if you go to the BOP statement, let me go to the, so it is roughly, matching. It is not exactly matching, but it is here and there, but it is matching. It's $46.6 billion. Here it is showing as $42.6 billion. So there could be some changes in the last quarter, which will get reflected here. But the most important thing to observe here, that there has been a substantial increase in gold reserve. So RBI has been buying gold. So though the foreign exchange reserve has increased, the number which is being shown as $50.5 billion is largely attributed to gold, increase of gold reserve by $8.4 billion compared to FY23. So this $50 billion, there has been a substantial portion of of gold of 8.4 billion. Now, why this is important? The reason this is important is that this purchase of gold by RBI is putting a pressure on rupee. Why it is pushing a less pressure on rupee? Because RBI is spending foreign exchange to buy gold and converting this foreign exchange in its balance sheet, this foreign exchange, whatever it is accumulating to buy gold in the balance sheet, which reflects in the total foreign exchange, because total foreign exchange is an addition of the foreign currency asset and gold. So, though the foreign exchange is being shown as very high, but the attribution of foreign exchange becoming so high can be directly, the gold is the direct responsibility of increasing foreign exchange reserve. Now you may say, and that is why this contradiction. So though there was a gold sovereign gold bond which is being aimed to decrease the imports of gold, but RBI purchasing gold directly is reflecting in our import-export statement as imports of gold, and that's why the gold import is increasing, which is quite contradictory and a paradoxical situation. So though we want the gold imports to go down, but since RBI is purchasing in order to do risk mitigation and diversification as far as the reserve is concerned, gold imports are increasing. So I may do a separate video on gold bonds separately. I don't want to confuse this video, otherwise this video will become too long. So you can clearly see the contradiction. Why there has been a demand for foreign exchange, and therefore the benefit that we should get on account of the higher foreign exchange we are not getting because of the fact that we are buying gold. So this is now put to the question is, why rupee depreciating, right? One point I have already answered, that because there has been a increased purchase of gold by RBI, which is putting pressure on rupee because there is a demand for foreign exchange to buy rupee. The other important point is that I'm going to take you through another chart which is very, very significant, which is, let me just go through, where is my chart here? Yeah, this is the chart. So this chart is going to answer many of your questions. Now, if you look at this chart, this gives you the balance sheet of RBI. Is a very, very important. One hand there is an asset, another is a liability. Now this balance sheet is going to tell you what the situation of foreign exchange reserve is. Now if I do an absolute foreign exchange reserve value as far as RBI is concerned in rupees lakh crore, you will find that our foreign exchange reserve has increased to 47.99 lakh crores by FY24. But if I do a percent of GDP, you will find that this has actually has depreciated. Whereas gold on a percent of GDP has increased. So therefore, the question that one should ask is that whether our increase of foreign exchange is good enough in order to sustain and prevent the depreciation of rupee or the weakening of rupee. That is the question, because as a percentage of GDP, that number is, see, look, it has been steadily going down, 19.81%. So this may not be a good reference because it's a COVID year. But let's look at FY22, 17.9%, 15.7%, now 16.33%. So on a percent of GDP, this number is equal to what we saw in FY16, FY18 or maybe FY15. So is our foreign exchange very high compared to our GDP? You have to ask this question. I mean, this is not the case. So therefore, all the positives that has gone into our economy has got balanced out because of certain negatives which are significant. What are those negatives? Rising external debt, increase of imports of gold, and increase of imports on electronics, right? Some of the items which we are trying our level best to curtail our imports. So those are putting a lot of pressure as far as our foreign exchange reserves are concerned. And our foreign exchange reserves are actually getting elevated because of purchase of gold, which is putting more demand on Forex, because you need Forex to buy gold. That is enhancing or indirectly depreciating our rupee, right? So this in short is the overall situation. Now I want to stop here because I don't want to take you through the sovereign gold bond and how it is going to impact, how it is impacting India's overall internal debt situation, what objectives RBI or the Indian government had to buy sovereign, to issue these bonds, the gold bonds, etc. I'll take you through all these concepts in a later video, but I would like to stop here because the video will become too long. Hopefully you have understood the numbers, and hopefully you will appreciate where the situation is, because doing nitty-gritties and trying to figure out, what is the foreign exchange situation as far as trading is concerned on a daily basis is very difficult thing to do. It's not possible. So you have to look at the overall picture to understand this situation, and I hope that you found this video very useful, and many thanks for watching till the end. Thank you very much, and I'll come back to you with a new video next time.